Most forex traders live and breathe candlestick patterns, from single candle to multiple candles patterns like doji, hanging man, engulfing bar, hammer, morning star, you name it. These patterns are everywhere in strategies, especially for spotting reversals. But here is the harsh truth: they fail as much as they work. In this video, I'll show you why relying on candlestick patterns alone is dangerous, and how you can go beyond the open, high, low, and close to truly understand why the same pattern that caused reversal now can still lead to continuation the next time it pops up on the chart. Without wasting any time, let's dive in. Candlestick anatomy is simple: open, high, low, and close. From this, we get all those classic candlestick patterns for reversal and swing continuation. Rejection candles like pin bars and engulfing candles are clean and they are very powerful until they are not. How many times have you taken a trade based on a perfect looking pin bar or engulfing candle only to watch price blow right past it in the opposite direction? It feels like a trap, right? That's because it often is. There are a couple of reasons why such traps happen. The first and the most important problem is institutional order or position on that asset. Where big players are positioned in the market matters a lot. When they are buying, for instance, no amount of candlestick reversal pattern or rejection is going to reverse price to sell off. If their orders are stacked to buy, your bearish pin bar is meaningless, and if their orders are stacked to sell, your bullish engulfing is completely useless. The solution to this problem is to always track the position of the institutional traders. Dealing banks and fund managers control the price in the money market. You can see the summary of their position for a weekly contract on the Commitment of Traders report or on the Traders in Financial Futures report. You can access these reports on the Commodity Futures Trading Commission's website, that is cftc.gov, and on third-party websites like tradingstar.com. The major challenges with these reports are the lack of details and the delay. The report publishes the net long and short positions from the open to the close of the weekly contract. That means Wednesday open to Tuesday close. But the report is made available for the public on Saturday. That is 3 trading days late. In addition to the delay, the days the orders were opened are not included. Price levels and pending orders are also not included. That is the advantage we have with our daily institutional orders data. It is reported at the end of the day, tells the position of the institutional trader on that day, relative size of the orders, and show the pending order levels. We have a Telegram channel where we share this data with interested traders. The link to join the channel is in the description of this video. Other than the position of the institutional traders, there is a deeper layer of candlesticks that most traders ignore. That is the multiple candles or price action inside the single candlestick. A 1 hour candle is made up of 60 1-minute candles. You can have 3 H1 pin bars that look the same, but on the inside, the price action tells 3 completely different stories. So all pin bars are not created equal. Let's take a look at these 2 examples. In both cases, we have a perfect buy setup, which is a sell side liquidity grab followed by a break of structure to the upside, then a retracement into the imbalance created by the bullish impulse. Right inside this point of interest is where the pin bar is formed. This confirms the buy setup for most retail traders. We got the reversal in the first case, whereas the retracement turned into a bearish break of structure and a loss for any buyer in the second case. Now let's take a look at why this happened. In the first case, taking a deeper look into the pin bar, we can see that after the candle opened, it went straight up, created an accumulation range, broke out and retested the range, then moved up to close above the open. This internal structure of the pin bar is a bullish structure, which confirms the pin bar as a bullish reversal candlestick. That is why the reversal happened and the trade played out as expected. However, in the second case, taking a deeper look into the pin bar, we can see that after the first candle opened, it created an accumulation range around the open, broke out bearish, came back into the accumulation range for a retest and closed above the open. This internal structure of this pin bar is a sell structure. Even though on a single bar view the candle is the same pin bar as in the first case. That is why the resulting move is bearish and not bullish as expected. So the only way to know the candlesticks that will support your bias is by understanding what happened inside the candle. The average trader only sees what's on the surface. To such traders, a bullish pin bar equals buy, a bearish engulfing equals sell, but without knowing how price moved during the candle's life, you are trading blind. This is why some of those picture perfect setups fail, because the confirmation are based on appearance and not on context. The market isn't reacting to the shape of the candle, it is reacting to the liquidity, volume, and institutional intent. So how do we fix this? The answer lies in volume profile or market profile. Volume profile shows how much volume was traded at each price level during a given time. You can apply it to a single candle or an entire session. This helps you see where most of the trading actually happened, not just where price passed through. For example, a bullish candle with a long lower wick might look strong, but if the volume profile shows that all the volume are at the top of that candle near the close, that's a red flag. We all know the basic law of trading: buy low, sell high. If most of the volume in a bullish bar is at the top of the bar, it's a bearish sign, and that bullish candle is not a good one. However, if most of the volume are around the low with the candle closing above it, it means the bullishness was sponsored by that volume, and that is a good bullish candle. Market profile, time price opportunity, which is also called TPO, gives similar insights as the volume profile. It tells you how long price spent at each level. This helps you to spot value areas, which serves as demand and supply zones, extremely low volume areas, which are imbalances, and the overall distribution of volume, things that candlestick patterns alone cannot show you. So it is not just about rejection candlestick patterns, but the context within that candle. In summary, I am not saying candlestick patterns are useless. They are useful, but they are just one piece of the puzzle. When you combine them with the internal story analysis and volume data, you go from guessing to understanding. To wrap it up, candlesticks lie without context. Institutional positioning overrides retail patterns. Every candle has a hidden structure inside it. Volume and market profile reveals those structures, which gives you an idea of the truth. If you want to trade like the pros, you have to think like them. Stop reacting to shapes and start understanding intent. If you have learned something in this video, go ahead and like the video right now. If you are yet to subscribe to the channel, hit the subscribe button and don't forget to turn on your post notification bell so that you get notified when we drop new videos. Leave your opinions and questions in the comment section. I'll see you guys on the next one. Have a great day.